rebalancing the priorities in terms of yield, liquidity and security. So hopefully you're in the right session with us this afternoon. So I really just wanted to kick off quite briefly and say, why are we here? Why did we think this was an interesting topic for us to discuss at this forum today? The global pandemic has clearly brought about disruption to all aspects of corporate life, and treasury management and liquidity management is clearly not an exception. Responding to the worldwide market disruption, treasurers have had to act swiftly and potentially adjust their liquidity management strategy, whilst also adopting new ways of working. Also, coupled with this, rates around the world have trended lower, and us and lots of other banks are calling for rates to be lower for longer. So with me this afternoon is a panel who will look at these themes and the implications for liquidity management and for treasurers around the world, and considering how they're rebalancing the priorities between liquidity, security and yield, and also picking up from the themes that were discussed in the sessions this morning, whether there should be a greater focus on ESG regarding the investment landscape. To help me discuss these themes and others, I have a very distinguished panel with me this afternoon. So I'd just like to hand over to each of them now just to briefly introduce themselves. Jane, can we start with you?
Yeah, of course. Thanks, Gareth. Good afternoon, everybody, and welcome to our session. My name's Jane Bonner. I'm the liquidity and investment consultant as part of our global liquidity and cash management team for HSBC UK. Primarily, my role involves speaking with larger corporate and MME clients together with their relationship teams to help them structure vanilla deposit solutions, but also look at other types of investments that they may wish to place cash funds in and bring in other colleagues from within the group to support those.
Thank you, Jane. Over to you, Olivier.
Good afternoon. So my name is Olivier Guénaud, and I'm overseeing the fund management for liquidity funds for Euro and Sterling in HSBC Global Asset Management. So my role is very clear. It's to manage liquidity funds for our clients.
Thanks, Olivier. And with us is also Andrew from Balfour Beatty. Andrew, can I just ask you to say a few words about your background?
Hi, thanks, Gareth. Yes, Andrew Belmont. I'm the Group Treasurer of Balfour Beatty, the global infrastructure business operating mainly in the UK, the US and Hong Kong. I'm the Group Treasurer. I've been in that role for 4 years, responsible for all of the global treasury activity, including funding, liquidity management, and everything in between. Prior to my time at Balfour Beatty, I was the Group Treasurer at Thames Water for over 10 years. And I'm a fellow of the ACT, I'm proud to say.
Thank you very much, all. And finally, just to introduce myself, Gareth Williams. I run the corporate desk at HSBC, helping our clients manage all aspects of market risk management, being it foreign exchange risk, interest rate risk, commodity risk, and as this session highlights, investments, and short-term investments, how clients can best use their excess cash and what other ways we can help them to get some kind of yield in this very low interest yield environment. Just a little bit of housekeeping. I understand on the right hand side of your screen where you can submit questions. There is more information about us as speakers. You can leave feedback, you can take notes and things like that. So if there are questions or thoughts that you'd like to put to us as a panel, please do use the toolbar, and hopefully we can cover some of those as we go through our discussion this afternoon. But without further ado, let's kick off. And I'd like to start, Andrew, with a question to yourself. As I kind of open the session, COVID has impacted us all, and will continue to impact us throughout the course of 2021, and maybe beyond. How did your liquidity management strategy stand up to the onslaught of COVID? And do you have to make any material changes or update your policy in order to react to COVID and what it calls for us in 2020?
Yes, I think it's a great question. It's probably a many-headed beast, to be honest. And I think you can split it between the strategic and the operational piece. I think for most treasurers, or everyone really, having that operational structure, this impacted in a world where everyone is remote working. At a drop of a hat, we've moved to a different way of working. You've got colleagues with different levels of experience and also different levels of automation in terms of how you operate. And that's both with your own team and with your relationship with your banks and liquidity funds, etc. So we were quite lucky or fortunate, but we've actually been through a transformation process over the last 2 to 3 years to automate our processes, to move to a place where we could access in remote working, introduce the new treasury management system. A lot of our trading is done remotely online versus via portals as opposed to directly. So we've done a lot of work to automate what we do and give ourselves a lot of flexibility. As with most treasury functions these days, relatively small team. So I think I think that's the first thing to put out there. I think the big challenge to all of us was that operational processes. Did you have a robust system, processes of treasury activity that would work? And so far that we've been able to pass that test, I think. I think then beyond that, we went to very close control of our cash forecasting, even more than we would normally. We went to, as an example, daily calls I held with the finance directors of all of our key business units, and we were getting to the site level of what does liquidity mean for us as a business, what was going to happen in that period, March to June, July, what we were going to see and how we were going to manage that. What was it going to do to our liquidity headroom? How much liquidity headroom we had under core bank facilities, but then also how were banks and funds responding in terms of how we wanted to manage our cash? I guess, like with everyone, the immediate knee-jerk reaction was to keep everything very short, because you really were dealing with the world. You didn't really know what was going to happen in the next steps, and really. I think to some extent that has happened. I think the other thing we saw, we didn't go down this route, but you've seen a number of people who are aware of people really pulling their RCFs and putting money on, pulling money out of RCFs even if they didn't need that liquidity. And so I think there's been lots of questions from the board, lots of challenges to say, well, how are you going to prepare, make sure your company has robust liquidity? So almost the question of what you're going to do with your cash, where you're going to invest it, are you going to change your thesis, your approach to liquidity, has been second to dealing with, I guess, all of the operational strategic risks that COVID has brought about.
And you talked about, I suppose, the knee-jerk reaction, making sure you knew where your cash was, really tightly monitoring it, and a huge amount of internal focus on liquidity. Are you still in that kind of phase, or has things relaxed slightly for you, and are you able to kind of segment your cash a little bit more and turn that out? Where are you on that timeline now?
Yeah, I think we're, I guess, quite lucky to be in one of those sectors where a lot of our activity was seen as critical. So a lot of our operating sites, although we had a period where things were shut down, things opened up pretty quickly, and we're up to reasonably sort of maximum level of capacity in our operating sites. So things we maintain that very close control, and we're carrying on that very short span of control on most activities from a liquidity perspective. But we have sort of, I guess, we're not necessarily as fraught as perhaps we were in the second quarter of last year, which means we can make some more strategic decisions. And I think that, and we'll come on to it, that then leads into more the debate around, in such a low yield environment and risks of negative rates around the corner, it makes the board and the treasury function look at, right, what is your strategy in terms of cash you need to retain? How are you managing that? How are you looking at security and yield? And then, what, from a corporate and a shareholder perspective, what are you doing with that cash?
Absolutely. How do you move from maintaining the liquidity and the safety to then okay, that now we've got that sorted, where's the next piece focus on? Let's bring Jane in now to the discussion, and it's a topic that Andrew kind of touched on, but cash flow forecasting, it has always been, at least with the corporates that I've been speaking to over the years, been like the holy grail, because if you get a reliable cash flow forecast, everything kind of builds on top of that from a treasurer's perspective, be it cash management, foreign exchange risk management, whatever else it is. And clearly a lot of companies have been affected by COVID, and it's been even more difficult for them / impossible to forecast their forward cash flows. With the clients that you're speaking to, how have you seen them deal with managing their future liquidity, given the impacts that COVID's affected on them?
Thanks, Gareth. Yeah, so very similar to Andrew, really, in many respects. Clients had short, medium, long-term strategic decisions that they'd already taken. All of those were pretty much thrown up in the air with COVID hitting. I've had clients say to me that they have changed their complete strategy. Many of them were impacted anyway by Brexit, dare I say. So a lot of them have been taking in additional stock, which has actually decreased the balances that they were holding. And with COVID hitting, that has had a double impact on that. As Andrew said, many firms took advantage of drawing down their RCFs and bounce back loans, COVID loans that were government backed. So that in turn brought more liquidity to them. But where do they put that? You know, many of my clients opened accounts, additional accounts with other counterparties, but equally HSBC last year opened several new deposit accounts for clients because there was a flight to quality. Our credit rating, you know, was very strong and has maintained that strength. So we were opening brand new accounts. I did also see clients being affected by their debtor days. So, you know, some of their debtors are saying, can they change their payment terms, which again would affect the liquidity that was coming into the firm. And equally, they were looking to change some of their terms with their suppliers. So a huge amount of different things going on in addition to just the day-to-day running of the business. Managing counterparty risk, you know, if drawing down these RCFs, they couldn't necessarily put them all with their transactional bankers, nor should they. And indeed, managing that liquidity risk as well. I think, if I'm truthful, security and liquidity has overshadowed yield, definitely. I haven't had that many conversations with clients looking to come to us for an enhanced yield. It's really been to spread counterparty risk and to ensure they've got the right amount of cash in the right account, in the right jurisdiction. And that's been more important to them. In terms of board decisions, board and management have asked clients to bring cash back and keep it on an overnight basis, which has pretty much flooded the market and again driven down the pricing that banks have been able to offer on those instant access products, because, you know, having an overfunded position and having to hold capital against instant access cash and unable to refinance it, you know, has driven down that pricing as well. So from a Treasury management perspective, as well as trying to keep themselves and their families safe during COVID, working from home, you know, trying to make sure that the money is in the right place at the right time has been a massive challenge. So many firms have gone from monthly reporting to weekly to daily. My hope is that with the vaccine now coming, things hopefully becoming a little bit more stable, there will be more line of sight over where the balances are going in the future for us and our clients.
Thank you. And bringing in a topic that Andrew mentioned, technology and the ability for technology to help inform a corporate treasurer where his cash or her cash and liquidity is, and then also to be able to reliably report back up the chain to the board around liquidity and cash. How have you seen that change, and how have you seen technology become even more focused? Clearly, it's been a theme or a continuing theme across all areas of Treasury, but specifically within the liquidity world. Has that changed, do you think, over the last year?
Yes, certainly. I mean, most firms or a lot of firms are still reliant on Excel spreadsheets. It's great, Andrew has the TMS system, and many large corporates do have that facility. But in the MME space and probably the lower end of larger corporate, they don't necessarily have robust treasury management systems. So as a bank, we've actually looked at that and have actually introduced a cash flow forecasting tool to automate some of these processes, because I had some clients saying to me that particularly where they were dealing across different business units or jurisdictions, that some of them were working off 16 spreadsheets per week. And when that went down to daily, it's a pretty mammoth task, very difficult to model the cash flow moving forward. And with some of this automation, with these tools, these cash flow forecasting tools, HSBC has one, but, other brands are available. It does enable a treasurer to have much more ability to model the cash flow on a more regular basis than they would be able to on a manual basis. Sharing Excel spreadsheets across jurisdictions has its problems. Andrew mentioned home access to systems, that has been a major factor as well. So we identified that as a problem. We have linked in with a very reputable fintech company to support us with this cash flow forecasting tool. And it is something that we're having very live conversations with our clients about at the moment.
Andrew, it sounds like from what you answered earlier that you've done a lot of housekeeping in this space to get your technology up to where it should be. I'm sure it's paid dividends over the last year. Well, what's been the key piece of technology you would say it's been critical for the Balfour Beatty Treasury to have?
Well, I think we were able to move our treasury management system so that it was web enabled. So previously it was very much driven off hardware. So we went through a system upgrade around 2 years ago, and that was the opportunity for us then to really align that system with our enterprise system. So we lined that with Oracle, so we had straight through processing and all of our treasury activity, but then into our accounting and corporate systems as well. So that was the critical piece for us, was to create that functionality so we could actually have single versions of the truth and an automated process across all of our really across all of our estate and how we worked. So actually, and that's paid dividends. And then we sort of moved, and we were in the process of a UK banking migration project actually when we went into lockdown. So we're moving. It's an accident, but HSBC won a lot of that business. But we were actually in the process of migrating and bringing things like virtual bank accounts and a whole range of new technology to our cash management processes that would give us, again, another sort of step forward from a technological perspective. So that I think I'm sure there's a lot of corporates are on a similar sort of path. But I think for us, you see with technology that things are now moving apace. It's a similar thing to ESG. I mean, I think the two themes are almost hand in hand, in as much as the face of a treasury operational function, what a team looks like and how it operates is very different now, even from 2 to 3 years ago. And I think with, again, the further technological shift, the challenges that COVID has brought, and ESG as well, the landscape's going to shift again.
Yeah.
In terms of what we're all doing and how we look at life over the next 18 months or so.
I just a question that maybe for the audience, how easy was it for you to secure the funding to enable you to make those system developments? Because often I talk to customers and they would like to iterate their systems, and they have an idea of where they want to get to, but within the funding cycle internally, it kind of falls down the radar. And I would say that, over the course of the year, being able to have the right systems in place so that you do know where your cash is, you can forecast it correctly, and you can have a team, firing all cylinders from a home environment has been hugely important. And was it difficult for you to get to that level where you had the right tools at your disposal? Go on, Jane, sorry.
I was just going to say, I think some of that decision has been a difficult one for some firms, because CapEx has been another thing that has been halted. With the uncertainty, even if a treasury management system was required, some firms have thought, should we actually commit that significant sum of money to put that in place? But Andrew, clearly it's worked for you, which is fabulous.
Yeah, I mean, from our point of view, we run with a shared service centre that manages most of our finance functions. So the investment in technology has been something that is, I guess, part of our culture. So it's been easy to ride along with that. Clearly, any investment has to earn a return on that investment, and it needs to be, within we're a low margin industry. So, nothing comes for free. But I think with teams that are, getting ever smaller, more professional, in terms of from a treasury perspective, and you've got less people, you actually need to have that those integrated processes and systems.
Absolutely. Olivia, let's bring you into the conversation now as well, if we can. So we've continually see from surveys, safety is absolutely the most important short-term investment criteria for corporates, followed by liquidity, and yield is well down the list of criteria, and it's very distant third. Have you seen any change within that for 2020? And then I think kind of a follow-up question, should a fourth criteria starting to come in as an objective, is ESG setting for investments?
Yeah, thanks, Gareth. Yeah, so I'll join really Andrew and Jane by saying that 2020 really was the year, as far as we could witness, of clients looking for security above everything, and that's obviously not surprising. Our funds are always targeting, preservation of capital and liquidity first, and yield being the resultant. And what we've seen in these funds, particularly in euro and sterling, is the fact that the size of these funds have doubled over last year, which is the greatest increase we've seen since, before the GFC, actually. So which shows that really most of the clients were actually and are still, for most of them, targeting security and yield. I think that there are several reasons as well for that. The first one, which have been alluded to, is that obviously within the pandemic, you want to build some supplemental liquidity cushion, at least in the beginning. And that's what really we saw in April and May, was a rapid rise in our assets, clients coming into the funds. And as well, what we've seen is that we've seen more clients coming into our funds because they have, I would say, a tendency to be a little bit safer than the competition. So we saw a premium to safety, really, within those markets. The third one, which is also quite important for us, is the fact that we've seen more financial companies coming into our funds. Traditionally, our sterling fund in particular is the client base is much more corporate, non-financial corporate rather than financial clients, and we've seen a lot of financial companies coming in, and I think that's related to what Jane was mentioning, i.e., the banks are obviously pricing the deposits in a different way depending on the client, with financial clients being at a disadvantage. So all things being equal, suddenly the liquidity funds became maybe a little bit more attractive to them. That might be one of the reasons as well. I think things are slightly changing, at least in intention. We are seeing some clients asking whether they could extend, and we could maybe come back to that. It's due to the fact that we are coming to near zero rates in USD and potentially negative rates in sterling. So we are offering solutions there as a seg mandate, because obviously going there means supplementary credit risk. Obviously you hopefully get more returns out of it, but you need to really size and understand the credit risks that are involved in this. And there's also another issue which is to be dealt with, which is that our understanding is that most UK auditors consider that this would not be cash and cash equivalent, or at least might be questioned. Again, it all depends on the market conditions at the moment, which are not really attractive at the moment, except maybe in US dollar. But that's something, that's really a trend that we are seeing, definitely. And coming to ESG, yes, that's also another trend that we've seen, definitely. We've seen more and more questions coming into the ESG. To be fair, we've seen more questions coming on the E letter than on the other ones. Environmental funds. So to be clear, we are integrating already within our fund management, and it's not only liquidity, it's within our equity bond funds. We are integrating ESG factors for a very simple reason, is that and when I focus on liquidity, when you have an ESG risk, it means that you have a credit risk. If an issuer is not handling properly environmental, social, or governance risk, this means that it has an impact on its credit worthiness. So that's already something that is embedded into our research, into our analysis, into our issuer approved list. Now, the questions we have been asked, and where we've worked quite extensively, is whether we can actually have a fund where we have a kind of best in breed into this, which we are working on at the moment. Again, if we think about impact investing, it's very important to understand that because most liquidity funds assets are composed of banks issuing papers, government papers, agencies, supranationals, and very few corporates, because actually very few corporates are issuing commercial papers. This means that if we want to have an impact from the ESG perspective on a liquidity fund, it's mostly the social and the governance impact that will be important. We can make some exclusions in our fund, saying that we will exclude the large polluters, for example, or those kind of exclusions. But actually, these are not in the fund simply because these issuers are not present in the market. So really, in order to have an impact, we are really focusing a lot on ES and SNG, although obviously we are also ascertaining environmental issues. So again, it's really the three letters that are important for us.
Thank you. And do you see, where are we in the cycle? Are people just asking questions, or are people actually putting their money to work with an ESG lens?
We've seen the assets of some ESG funds coming up last year. So the question whether these funds are really environmental or ESG funds is an open question. So that's really again the question of impact investing, which is important. But as far as we could see, when we actually made a kind of survey with our clients and prospects, and definitely the question is arising for more than half of our client base, but the actual practice is actually much more limited at the moment. So we believe that at the moment the clients and the prospects are more in a process of thinking and seeing whether they can actually integrate ESG matters into their liquidity fund management and probably treasury systems.
Widely.
Yeah.
Yeah. Okay. Andrew, how does ESG feature within the Balfour Beatty context?
I guess we're in a similar sort of place of evolution as a number of people. We just published our revised Building New Futures Sustainability strategy just before Christmas, and I've been talking to our sustainability team about the last couple of years, and it's been around, we've attended conferences together, we've looked at green bonds, we've looked at the whole question of how we align the two, our finance strategy, our financial strategy, our treasury strategy, and the whole ESG environment. And I think it's been quite difficult. And I feel now, I guess over the last year, but I think now we are starting to get much more of a framework and much more understanding. There's a real step forward as to how companies under a lot more both moral and regulatory pressure to ensure that they are focused on sustainability. So, for us, that strategy is now front and center, and we're doing the work now, which says, okay, how does that impact on our finance strategy, on our liquidity management strategy, on our treasury strategy? I'm really a firm believer that, it has to be an enterprise-wide strategy. Unless you're living and breathing something, you can't really introduce it to your financing strategy, to your liquidity management strategy. It needs to be something that's credible. And not just that I can put a green bond flag on something and say I've done it. And I think the market now is moving at a pace towards making this three-dimensional living, breathing thing, which is really exciting. So we're doing a lot of work now around that strategy, how we then utilize that and make the changes in our treasury policy over the next year that mean the two things are lockstep going forward. And that's the work. That's a big project for us this year, and I'm sure that's the same across most UK corporates.
Yeah, absolutely. For the names and clients that I interact with, it's what is the corporate green ESG strategy, and then how does the treasury function fit within that strategy? And it's got to be meaningful, otherwise, what's the point? It doesn't fall into the greenwashing kind of segment of discussion.
Yeah.
And then from our side, on the banking side, it's how do we support our clients through this journey? And one of the ways that we've been thinking about this is clearly the green financing space has been around, or the ESG, I should say, financing space has been around for a long time, and there is there's a price advantage potentially from doing green versus non-green bonds. But then what's the next phase? Often clients will have to raise some kind of debt, be it in the public markets or be it through bank debt. But then often there's what do you do with that cash in the short term? There's green deposits, there's we can do green repo, there's other products, because there's normally a timing mismatch between raising the funds and then utilizing the funds. And then often, over debt issuance, there's some kind of derivative trades. Maybe you're looking to, fix the interest rate risk or float the interest rate risk. Can we then, as a banking world, add ESG derivatives over the top? So actually, you're going from financing to investment to derivatives, and you've got an ESG theme through the whole piece to make it much more impactful and much more insightful for the entire package. And I think that story is going to continue clearly, and it's a massive theme for both corporates and for banks, and it will continue as it quite rightly should. I can see that we're kind of moving into the last minutes of the session, and one area that we haven't really touched on yet is the rate cycle and where we are in the rate cycle. And given the fact that COVID hit last year, central banks smashed rates down. We have seen recently the kind of the dollar curve really pick up at the back end, but still short-term rates are very, very low. Andrew, has the low rate cycle changed your investment criteria, products that you use, tenor that you invest cash? Has the ball now changed slightly from we want to understand where the cash is to, okay, now let's try and maximize the returns we get from that cash within kind of set criteria?
I think that to the point Olivier made before, I think it's going to take a long time for people to shift away from security. If you think for most treasury functions and most board of directors, they're going to get no prizes from shareholders if you've earned an extra 15 basis points, but cash disappears.
Yeah, absolutely.
I think, and that's ever been the case, but I think ever now it's probably even more important. I think it's going to bring into sharp focus the whole concept of core cash, return on capital. In some ways, there's a little bit of moral hazard around negative interest rates, and I know the Bank of England think about these sorts of things because clearly, from a capital structure perspective, you need to make sure you retain strong liquidity. For us, we run our business with average net cash. That's a core pillar of our strategy. We run with high commercial risk, high business risk, so we run with low financial risk. But we maintain that core level of liquidity. Now, what we don't want to be is in a situation where the board say, well, actually, I'm getting no return on that money. I don't want you to do that. I want you to take more risk with that from a financial risk perspective. That is not the right place for anyone to be driven towards. So you have to have that sustainable, efficient capital structure. I think what it will force companies to look at then, well, why, which is classically why we're into a negative rate strategy. Why are you holding cash? What are you investing? What are the opportunities to invest your cash? What are you doing with it outside of liquidity? So it will be almost force you to limit the amount that you're holding in short-term liquidity and look at what are you doing to earn a shareholder return. So is that, could be return of capital shift to shareholders, or it could be to look at investing in terms of M&A or investing in new projects. So I think it will open up a wider realm of what we do with cash. And I think it makes that relationship with the board really important, because a bit like the debate around should I pull all my RCFs and hold that cash?
Yeah.
Well, the reality is most banks have a right of set-off. So have you achieved anything by doing that? The Treasury team has to be able to explain to the board what is an efficient financing strategy, what is the right liquidity strategy, and why it's important then to maintain that liquidity. And then I think it's having those bands, and it may be there's some segmentation, some view of risk, so you actually have a band in terms of what you're going to try and earn. But I think it going back to where I started in my response here, I think it's going to be a defensive strategy. I can't see that changing in the short term, but I think boards will be more aggressive to say, well, okay, what is it you're doing with your cash in the widest sense?
Jane, Olivier, comments on that?
I was just going to say, from a bank's perspective, we would love to have a crystal ball and see into every boardroom and, see what's going on, because we are sitting on this huge amount of liquidity. And what we don't know, what is the uncertain item here is, when will it be spent? And will that then change our balance sheet requirements, and will that drive rates up? Because there will be a need for us to bring in more deposits. So, we are seeing businesses now look at some of the longer term rates, but, longer term rates are still not that great. So why lock it up for 6 months when you could, to Andrew's point, do something more with it within the business? It's not the main purpose for having the cash necessarily, is just the interest rate. So, it's going to be a very, very interesting year. I mean, I've been in liquidity for about 16 years now, and every year has been different, but I don't think I've seen a year like this.
And let's hope we don't see many more either.
No.
Oh, indeed. And Andrew perfectly illustrated why, at least the limits of negative interest rate policy, because some of the central bankers believe that this putting rates to negative territory will push investors out automatically to longer tenors in order to avoid negative rates. And we have a good yardstick, which is euro, because we are living with negative rates in the Eurozone since 2014. And yes, it's right. In the beginning, there is a bit of a yield curve play around zero. But after a while, and especially when rates become decisively negative, then companies and investors and consumers come back to their usual way of thinking, which is, set up the risk framework and get the yield that corresponds to that risk framework, which is exactly the right way to think. So, yeah, I completely agree with what's been said here.
Yeah, and I think, from my desk and what we see outside of the vanilla corporate deposits, safety and counterparty risk really are driving products that clients are using. So reverse repo has grown, taking collateral on the back of cash that clients are placing, looking at other options around counterparty friendly ways to invest cash for a short term, highly liquid asset, be it making sure cash and cash equivalent accounting is still hugely important for a lot of customers to make sure their net that cash is included in the net debt calculation. The conversation is often driven by, actually, I've run out of places to put my cash in a counterparty friendly way. Yield isn't necessarily the driver. If there's a nuance in a certain market, yes, clients will move as long as it ticks the other boxes. But often the kind of conversations we're having with clients is, actually, I'm full on my bank counterparty risk, I'm full on my liquidity counterparty risk, and yet I've still got cash to invest. What other products and services can I look at that tick the counterparty risk? And I think that's a continual theme that we've seen and will continue to see, to make sure that the cash that everybody's worked so hard to generate or to safeguard is as Andrew said, it's not going to disappear overnight because you've put it in a dodgy investment. The yield is clearly the last piece of the conversation. As we step through kind of 2021, and potentially we see the economy starting to come back. Jane, this is a kind of question we touched on previously, and you mentioned it. Do you think the investment landscape is continue to get more complicated for customers? I think over the last few years, we've seen banks have different liquidity ratios coming in, different balance sheet, slightly different products, overnight cash, 31-day ENAs, all these different things. Depending whether you're a corporate client investing cash or a financial institution investing cash, that has a different liquidity need for banks, and therefore the kind of the menu of options, if you like, for the deposits has continued to increase, and it can be more complicated for clients. Do you think that's going to continue, or do you think it's going to get easier? How do you see this year kind of panning out?
So I think we will look to simplify. I certainly think in HSBC UK we have simplified products. I think there are some basic products. Clients have their current account, their operational cash. They have perhaps an instant access savings account. Then they might look for sweeping money market funds because of the security of those, the credit rating. I think notice accounts and perhaps longer term notice accounts are useful. Certainly our 31-day notice account, which again is available across other banks as well, a similar product, and other notice accounts where they're very, very buffer efficient for banks because it's a perpetual notice that is there. So I think there's probably be more of those, and term deposits. I don't see it getting any more complicated than that really in the cash arena.
Thank you. Olivier, from the liquidity fund side?
Yes, definitely. I believe that what we are seeing is a little bit of a mix between, as we've said, a continued search for liquidity, and that's going probably to be for the bulk of the assets, but as well some search for maybe some alternative to get in, if you can tranche cash, to get a slightly higher yield within a reasonable risk framework. That's what we are seeing at the moment.
Yeah, thank you very much. Yeah, the segmentation of cash, I think, is a conversation that we see starting to develop, and I think has more room to develop throughout the course of this year. Clients who are able to segment their cash operational cash, working capital cash, and maybe strategic or long-term cash where they can put that to work for a bit longer. I can see from the clock we're pretty much out of time, so really thank you very much for your time, Jane and Olivia, and a special thanks for Andrew for joining us this afternoon. I think it's been a great debate and a great conversation, and thank you everybody else for joining us. I hope you've enjoyed this seminar. As I've said, you know, if you want to add questions or drop us a note, please use the functionality on the system, and enjoy the rest of the forum. Many thanks for joining.